Hello, today we are going to talk about cryptocurrency and blockchain and what are they? Cryptocurrency is a type of digital currency that uses cryptography to secure transactions, control access, and verify the transfer of assets. It was invented in 2008 by an unknown person, or group, under the name Bitcoin. Since then, cryptocurrency has gained popularity and acceptance among people around the world. How does cryptocurrency work? A cryptocurrency is a type of digital currency that uses cryptography to secure transactions, control access, and verify user identities. They were originally designed to function as an alternative to traditional forms of money such as cash, credit cards, checks, and electronic payment systems. Cryptocurrencies are also used as a means of exchanging information online without the risk of censorship or interference. Bitcoin was the first cryptocurrency, first outlined in principle by Satoshi Nakamoto in a 2008 paper titled Bitcoin, a peer-to-peer electronic cash system. Nakamoto described the project as an electronic payment system based on cryptographic proof instead of trust. That cryptographic proof comes in the form of transactions that are verified and recorded on a blockchain. What is a blockchain? A blockchain is a public record of every transaction ever conducted within a digital currency network. It is also a shared database where each member can verify the validity of any transaction performed by another user. Imagine a book where you write down everything you spend money on each day, says Buchi Okura, CEO and co-founder of African cryptocurrency exchange Quidax. Each page is similar to a block, and the entire book, a group of pages, is a blockchain. With a blockchain, every user has a copy of the ledger, so they can see what happened before they made a transaction. Every transaction is recorded, and every copy of this ledger is updated simultaneously with the latest transactions. To prevent fraud or errors, each transaction is verified using a validation method, such as proof of stake or proof of work. Proof of work versus proof of stake. Proof of work, POW, and proof of stake, POS, are the two most widely adopted consensus algorithms to validate transactions on blockchains. These algorithms differ in how they verify transactions. POW requires miners to solve complex mathematical problems to add new blocks to the chain. In contrast, POS rewards validators who contribute to maintaining the network by staking coins. Proof of work. Proof of work is a method of verifying transactions on a blockchain in which an algorithm provides a mathematical problem that computers race to solve, says Simon Oxenham, social media manager at xcoins.com. Each participating computer, referred to as a miner, solves a mathematical problem that helps verify a group transaction, referred to as a block, then adds them to the blockchain record. The first computer to complete the task receives a reward of cryptocurrency. Bitcoins, for example, rewards miners 6.25 bitcoins, $200,000, for each block verified. The race to solve blockchain problems can require intense computer power and electricity. That means miners may barely break even with the cryptocurrencies they receive for verifying transactions after considering the cost of power and computing resources needed. Proof of stake. Some cryptocurrencies use a proof of stake verification method to reduce the power necessary to check transactions, so that fewer people are needed to do so. With proof of stake, POS, the number of transactions each user can verify is limited by how much cryptocurrency he or she is willing to stake, or temporarily lock up in an online safe for the chance to take part in the process. It's almost like bank collateral, says Okura. Each user who stakes crypto is eligible for verification, but the odds of being selected typically increase with the amount he or she fronts. Because proof of stake removes energy-intensive equation solving, it's much more efficient than proof of work, allowing for faster verification, confirmation times for transactions, says Anton Altman, CEO of Ozone Finance. In comparison, For instance, the average transaction speed of Bitcoin is about 10 minutes. Now compare that to Solana, a crypto network that utilizes the proof-of-staking mechanism, which averages around 3,000 transactions per second, TPS. That's far quicker than the sluggish Bitcoin blockchain, and also Ethereum, which is switching fully to a proof-of-stake mechanism. Ethereum estimates that its energy usage will drop by 99% once it closes the final chapter of proof-of-work on Ethereum. The role of consensus. In cryptocurrency, both proof-of-stake and proof-of-work rely on consensus mechanisms to validate transactions. This means while both utilize individual users to verify transactions, however, each verified transaction must then be checked and approved by a majority of ledger holders. How can you mine cryptocurrency? Mining is how new units of cryptocurrency are released into the world, generally in exchange for validating transactions. While it's theoretically possible for the average person to mine cryptocurrency, it's increasingly difficult in proof-of-work systems, like Bitcoin. As the Bitcoin network grows, it gets more complicated, and more processing power is required, says Spencer Montgomery, founder of Uinta Crypto Consulting. The average consumer used to be able to do this, but now it's just too expensive. Proof-of-work cryptocurrencies also require huge amounts of energy to mine. For example, Bitcoin mining currently consumes electricity at an annualized rate of 127 terawatt/hours TWh, which exceeds our sale total annual electricity consumption according to the World Energy Outlook report from 2019. While it's impractical for the average need to be mined in a proof-of-work system, the proof-of-stake system requires less high-powered computing as validators are chosen randomly based on the stake they have on offerings. It does, however, require that you already own a crypto coin participate. If you have nothing to stake, how can you use cryptocurrency? While there are a variety of goods and services that one can purchase with cryptocurrency, particularly with Litecoin or Bitcoin, you may also use cryptocurrency as an alternative investment option. The best-known crypto, Bitcoin, is a secure, decentralized currency that has become a store of value like gold, says David Zieler, a cryptocurrency expert at financial news site Money Morning. Some people even refer to it as digital gold. How to use cryptography? For secure transactions, in order to make secure payments, you'll need a digital currency wallet. A hot wallet is one such example. These wallets allow you to store your funds online so you can access them quickly. You can also transfer funds between multiple accounts within the same wallet. However, if you lose control of your private key, you could lose access to your money. To avoid losing access to your funds, you should keep a backup of your private keys offline. Another method of securing your funds is through cold storage. Cold storage involves storing your coins offline in an encrypted file. When you're ready to make a purchase, you can retrieve your coins from cold storage and then transfer them into a hot wallet. Once you've made the transaction, you can delete the original file containing your coins. This ensures that no one else can ever see your coins again. Finally, you can choose to only spend your coins once you've verified the transaction. This prevents others from spending your coins before you do. Best crypto exchanges. Some people believe that cryptocurrency trading is a speculative investment vehicle, where you invest money into a company without any guarantee of financial return. However, others believe that cryptocurrency trading is an opportunity to get rich quick. In order to succeed, you must learn how to invest wisely and avoid common pitfalls. How to invest in cryptocurrency. Some brokerage platforms, like Robinhood, Webull and eToro, let you invest in crypto. That's in addition to crypto exchanges. It's best to keep in mind that buying individual cryptocurrencies are similar to buying individual stocks. In essence, they are risk assets. If you want exposure to the crypto market, you might invest in individual stocks of crypto companies. There are also a few Bitcoin mining stocks such as Hive Blockchain, HIVE, says Zila. If you want some crypto exposure with less risk, you can invest in big companies that are adopting blockchain technology, such as IBM, Bank of America and Microsoft. How does cryptocurrency gain value? Let's take a look at the ultimate crypto bellwether, Bitcoin. In 2019, Bitcoin nearly quadrupled in price, closing out the year at almost $20,000. By April 2020, the price of BTC was back up to over $10,000. But by October, the price had fallen below $7,500 and by December, BTC was trading for under $5,000. So far in 2020, Bitcoin has gained more than 100%, but it's also lost more than 50%. At the start of 2020, one Bitcoin was worth $11,000. Today it's worth $3,800. Should you invest in cryptocurrency? Experts hold mixed opinions on whether you should invest in cryptocurrency. Because cryptocurrencies are so volatile, experts say they're not suitable for retirement accounts or day-to-day spending. Some financial advisors say you shouldn't invest in any cryptocurrency because of the risk involved. Others say you could make money if you buy low and sell high. Still others say you should avoid cryptocurrency altogether. Cryptocurrencies are digital currencies that are used online. They were invented in 2008 and are based on cryptography. They work similarly to traditional currency, except that they do not rely on a central bank or government. Cryptocurrencies are decentralized, meaning that no single person or group controls them. Decentralized systems are often considered more secure than centralized ones. Cryptocurrencies are traded electronically between users via a peer-to-peer network called blockchain. Pros and cons of cryptocurrency. Peter Pallion, a CFP in East Norwich, New York, thinks it'd be safer to stick to a traditional currency backed by a government. If you have the US dollar in your cash reserves, you know you can pay your mortgage, you can pay your electricity bill, Pallion says. When you look at the last 12 months, Bitcoin looks basically like my last EKG, and the US dollar index is more or less a flat line. Something that drops by 50% is not suitable for anything but speculation. That said, for clients who are specifically interested in cryptocurrency, Ian Harvey, a New York-based wealth advisor, helps them put some money into it. The weight in a client's portfolio should be large enough to feel meaningful while not derailing their long-term plan should the investment go to zero, says Harvey. As for how much to invest, Harvey talks to investors about what percentage of their portfolio they're willing to lose if the investment goes south. It could be 1% to 5%, it could be 10%, he says. It depends on how much they have now, and what's really at stake for them, from a loss perspective. Thank you for watching. Don't forget to subscribe and hit the bell.